Hello and welcome. In this course, we will explore presentation of financial statements based on International Accounting Standard 1. In April 2001, the International Accounting Standards Board, IASB, adopted IAS 1, Presentation of Financial Statements, a standard that was originally issued by the International Accounting Standards Committee in September 1997. This new standard replaced several earlier documents, including IAS 1 on the disclosure of accounting policies, issued in 1975, IAS 5 on information to be disclosed in financial statements, approved in 1977, and IAS 13 on the presentation of current assets and liabilities, approved in 1979. Later, in December 2003, the IASB released a revised version of IAS 1 as part of its ongoing technical projects. The standard underwent another amendment in September 2007, which introduced changes related to the presentation of owner changes in equity and comprehensive income, as well as updated terminology for the titles of financial statements. The most recent amendment came in June 2011, with improvements made to the presentation of items within other comprehensive income. In April 2001, the International Accounting Standards Board, IASB, adopted IAS 1, Presentation of Financial Statements, a standard first issued by the International Accounting Standards Committee in September 1997. This version of IAS 1 replaced several older standards, including IAS 1 on the disclosure of accounting policies from 1975, IAS 5 on information to be disclosed in financial statements from 1977, and IAS 13 on the presentation of current assets and liabilities from 1979. The IASB revisited IAS 1 in December 2003, issuing a revised version as part of its initial agenda of technical projects. In September 2007, the board made further amendments to the standard, addressing the presentation of owner changes in equity and comprehensive income, as well as updating the terminology used in the titles of financial statements. Another revision came in June 2011, focusing on how items in other comprehensive income should be presented to enhance clarity and consistency. The amendments to IAS 1 introduced in December 2014 under the Disclosure Initiative, aimed to address concerns around presentation and disclosure requirements. This allowed entities greater flexibility to exercise judgment when applying these requirements, particularly in ensuring clarity in the presentation of financial statements. One of the key changes was the clarification of the requirements in paragraph 82A of IAS 1. In October 2018, further changes were made with the issuance of the Definition of Material Amendments, which impacted both IAS 1 and IAS 8. These amendments were designed to improve and clarify the definition of material. The changes included incorporating guidance that had previously been found elsewhere in IFRS standards, refining the accompanying explanations, and ensuring consistency in the material definition across all IFRS standards. These updates were intended to make it easier for entities to apply the definition of material consistently, aligning it more closely with how materiality is understood and used in practice across financial reporting. In January 2020, the board introduced amendments to IAS 1 regarding the classification of liabilities as current or non-current. These amendments aim to clarify the criteria for determining whether a liability should be classified as non-current, emphasizing that an entity must have the right to defer settlement of the liability for at least 12 months after the reporting period. This clarification was intended to ensure consistency in financial reporting and provide a clearer picture of an entity's financial position. Later, in July 2020, the board issued another update to IAS 1, specifically addressing the effective date of these amendments. Recognizing the need for additional time to implement the changes, the board decided to defer the mandatory effective date. As a result, the amendments related to the classification of liabilities would now apply to annual reporting periods beginning on or after January 1, 2023. This postponement allowed entities to better prepare for the new classification requirements and ensure compliance with the updated standard. In January 2020, the board introduced amendments to IAS 1 regarding the classification of liabilities as current or non-current. These amendments aim to clarify the criteria for determining whether a liability should be classified as non-current, emphasizing that an entity must have the right to defer settlement of the liability for at least 12 months after the reporting period. This clarification was intended to ensure consistency in financial reporting and provide a clearer picture of an entity's financial position. Later, in July 2020, the board issued another update to IAS 1 specifically addressing the effective date of these amendments. Recognizing the need for additional time to implement the changes, the board decided to defer the mandatory effective date. As a result, the amendments related to the classification of liabilities would now apply to annual reporting periods beginning on or after January 1st, 2023. This postponement allowed entities to better prepare for the new classification requirements and ensure compliance with the updated standard. In February 2021, the International Accounting Standards Board, IASB, issued the Disclosure of Accounting Policies Amendment, which modified IAS 1 and IFRS Practice Statement 2 on making materiality judgments. The change replaced the requirement for entities to disclose their significant accounting policies with the requirement to disclose material accounting policy information. This adjustment aimed to provide more relevant and focused disclosures for financial statement users. In October 2022, the IASB released amendments under the title Non-Current Liabilities with Covenants. These changes improved the information entities must provide when their right to defer the settlement of a liability for at least 12 months is contingent upon compliance with covenants. The amendments also addressed concerns raised by stakeholders regarding the classification of such liabilities as either current or non-current, offering clearer guidance on this matter. Various other standards have introduced minor amendments to IAS 1 over the years. These amendments stem from updates such as the improvements to IFRSs released in April and May 2009 and 2010. In addition, IFRS 10 on consolidated financial statements, IFRS 12 on disclosures of interests in other entities, and IFRS 13 on fair value measurement were all issued in May 2011. Other updates include IAS 19 on employee benefits. In June 2011, the annual improvements to IFRS's 2009-2011 cycle in May 2012, and IFRS 9 concerning financial instruments in November 2013. Over time, additional amendments to IFRS 9, IFRS 7, and IAS 39 were made to incorporate hedge accounting changes. The introduction of IFRS 15 on revenue from contracts with customers came in May 2014, followed by amendments to IAS 16 and IAS 41 regarding agriculture bearer plants in June 2014. IFRS 9 was updated further in July 2014, and IFRS 16 on leases was introduced in January 2016, along with amendments to IAS 7 under the Disclosure Initiative. Further significant changes included the issuance of IFRS 17 on insurance contracts in May 2017, amendments to references to the conceptual framework in IFRS standards in March 2018, and the final amendments to IFRS 17 in June 2020. These various updates have continued to refine and shape the application of IAS 1. Various other standards have introduced minor amendments to IAS 1 over the years. These amendments stem from updates such as the improvements to IFRSs released in April and May 2009 and 2010. In addition, IFRS 10 on consolidated financial statements, IFRS 12 on disclosures of interests in other entities, and IFRS 13 on fair value measurement were all issued in May 2011. Other updates include IAS 19 on employee benefits. In June 2011, the annual improvements to IFRS's 2009-2011 cycle in May 2012, and IFRS 9 concerning financial instruments in November 2013. Over time, additional amendments to IFRS 9, IFRS 7, and IAS 39 were made to incorporate hedge accounting changes. The introduction of IFRS 15 on revenue from contracts with customers came in May 2014, followed by amendments to IAS 16 and IAS 41 regarding agriculture bearer plants in June 2014. IFRS 9 was updated further in July 2014, and IFRS 16 on leases was introduced in January 2016, along with amendments to IAS 7 under the Disclosure Initiative. Further significant changes included the issuance of IFRS 17 on insurance contracts in May 2017, amendments to references to the conceptual framework in IFRS standards in March 2018, and the final amendments to IFRS 17 in June 2020. These various updates have continued to refine and shape the application of IAS 1. The objective of this standard is to establish the foundation for presenting general-purpose financial statements. Its purpose is to ensure that these statements are comparable not only with the entity's own financial statements from previous periods, but also with the financial statements of other entities. The standard outlines the broad requirements for how financial statements should be presented, provides guidelines for their structure, and sets minimum content requirements to ensure consistency and clarity in financial reporting. This standard is applicable when preparing and presenting general-purpose financial statements in line with International Financial Reporting Standards, IFRSs, while other IFRSs provide specific guidance on the recognition, measurement, and disclosure of individual transactions and events. This standard focuses on the overall presentation. It does not apply to the structure or content of condensed interim financial statements, which are prepared under IAS 34 Interim Financial Reporting. Additionally, this standard applies universally to all entities, including those that prepare consolidated financial statements in accordance with IFRS 10 and those that prepare separate financial statements under IAS 27. This standard uses terminology primarily suited for profit-oriented entities, including those in the public sector that operate with a business focus. Entities involved in not-for-profit activities, whether in the private or public sector, may need to modify the descriptions used for specific line items in their financial statements as well as for the financial statements themselves. Similarly, entities that do not have equity as defined in IAS 32 financial instruments, presentations such as certain mutual funds, or entities where share capital is not considered equity, like some cooperative entities, may need to adjust how they present members' or unit holders' interests in their financial statements. In this standard, the following terms are used with the meanings specified. Accounting policies are defined in IAS 8 accounting policies, changes in accounting estimates and errors, and the term is used here with the same meaning. General-purpose financial statements, referred to as financial statements, are those intended to meet the needs of users who do not have the ability to request an entity to prepare reports tailored specifically to their information needs. Impracticable refers to a situation where applying a requirement is not feasible for the entity, even after making every reasonable effort to do so. International Financial Reporting Standards, IFRSs, refer to the standards and interpretations issued by the International Accounting Standards Board, IASB. These include International Financial Reporting Standards, IFRSs, International Accounting Standards, IASS, IFRIC interpretations, and SISI interpretations. Material information is defined as any information that, if omitted, misstated, or obscured, could reasonably be expected to influence the decisions of the primary users of general-purpose financial statements. These users rely on the financial information provided by the statements to make decisions about a specific reporting entity. Materiality is determined by the nature or magnitude of the information, or both. An entity must assess whether information, whether considered on its own or in combination with other details, is material within the context of its financial statements as a whole. Information is considered obscured if it is presented in a way that has the same effect on primary users of the financial statements as omitting or misstating that information. Examples of situations that may cause material information to be obscured include: material information in financial statements should be presented clearly and effectively to ensure users can understand its significance. However, issues arise when the language used is vague or unclear, making it difficult to interpret the disclosed details about a material item, transaction, or event. Additionally, if relevant information is scattered throughout the financial statements rather than presented in a structured manner, it can hinder comprehension. Problems also occur when dissimilar items are improperly grouped together or when similar items are unnecessarily separated, leading to confusion. Furthermore, the inclusion of excessive immaterial information can obscure important details, making it challenging for primary users to distinguish what is truly significant. When assessing whether information could reasonably be expected to influence decisions made by the primary users of a specific reporting entity's general-purpose financial statements, the entity must take into account both the characteristics of these users and the entity's own circumstances. Many existing and potential investors, lenders, and other creditors do not have the ability to request information directly from reporting entities. As a result, they rely on general-purpose financial statements for much of the financial information they need. These users are considered the primary audience for these statements. Financial statements are prepared with the understanding that the users have a reasonable knowledge of business and economic activities and will review and analyze the information carefully. However, even well-informed and diligent users may occasionally require the assistance of an advisor to fully understand complex economic phenomena presented in the financial statements. Notes to the financial statements provide additional information beyond what is presented in the statement of financial position, the statements of profit or loss, and other comprehensive income, the statement of changes in equity, and the statement of cash flows. These notes offer detailed narrative descriptions or breakdowns of the items shown in those statements. They also include information about items that do not meet the recognition criteria for inclusion in those primary financial statements. Other comprehensive income refers to income and expenses, including reclassification adjustments that are not recognized in profit or loss. These items are reported separately as required or permitted by other international financial reporting standards. Other comprehensive income consists of several key components that reflect changes in an entity's financial position beyond those included in profit or loss. These include adjustments to the revaluation surplus, which arise when assets are remeasured at fair value. It also encompasses remeasurements of defined benefit plans, capturing actuarial gains or losses. Additionally, foreign exchange differences resulting from the translation of financial statements of a foreign operation are included. Changes in the fair value of equity investments designated at fair value through other comprehensive income, as well as gains and losses on financial assets measured at fair value through other comprehensive income, also form part of this category. Other comprehensive income also includes the effective portion of gains and losses on hedging instruments used in cash flow hedges, as well as those related to hedging investments in equity instruments measured at fair value through other comprehensive income. Additionally, for certain liabilities designated at fair value through profit or loss, any changes in fair value that result from fluctuations in the liability's credit risk are recognized in this category. Furthermore, when an option contract is used as a hedging instrument, changes in the time value of the option, separated from its intrinsic value, are also reflected in other comprehensive income. Other comprehensive income also captures changes in the value of the forward elements of forward contracts when these elements are separated from the spot element and only the changes in the spot element are designated as the hedging instrument. Additionally, fluctuations in the foreign currency basis spread of a financial instrument when excluded from the hedging designation are reflected in this category. Furthermore, insurance finance income and expenses from contracts covered under IFRS the 17th of May be included in other comprehensive income if they are excluded from profit or loss due to a systematic allocation approach or to eliminate accounting mismatches with the finance income or expenses of the underlying items. Other comprehensive income also includes finance income and expenses from reinsurance contracts held, which are excluded from profit or loss when they are disaggregated in a way that allocates a portion systematically or eliminates accounting mismatches. In financial reporting, owners are defined as holders of instruments classified as equity. Profit or loss represents the net result of income minus expenses, excluding any components recorded in other comprehensive income. Additionally, reclassification adjustments refer to amounts that were initially recognized in other comprehensive income in the current or prior periods but have now been transferred to profit or loss in the current period. Total comprehensive income represents the overall change in an entity's equity during a given period, excluding changes that result from transactions with owners in their capacity as owners. It encompasses both profit or loss and other comprehensive income, capturing all financial performance elements beyond direct owner-related transactions. While this standard uses specific terms such as other comprehensive income, profit or loss, and total comprehensive income, entities may use alternative terminology provided that the meaning remains clear. For instance, some entities may refer to profit or loss as net income while maintaining consistency in financial reporting. A puttable financial instrument classified as an equity instrument is one that requires the entity to distribute a proportional share of its net assets to the holder, but only upon liquidation. Despite representing an obligation, it is treated as equity rather than a liability, provided it meets specific criteria outlined in financial reporting standards. In this section of the course, we will focus on financial statements. Understanding financial statements is essential for interpreting an entity's financial position, performance, and cash flows, ensuring transparency and informed decision-making. Financial statements serve as a structured representation of an entity's financial position and performance, offering essential information to various stakeholders for economic decision-making. Their primary purpose is to provide insights into an entity's financial health by detailing its financial position, performance, and cash flows. Additionally, financial statements reflect how effectively management has utilized the resources entrusted to them. To achieve this, they include key information about an entity's assets, which represent economic resources, and liabilities, which reflect the obligations the entity must fulfill. Financial statements also provide information about an entity's equity, which represents the residual interest in its assets after deducting liabilities. They detail income and expenses, including gains and losses, to reflect financial performance over a given period. Additionally, they disclose contributions by and distributions to owners in their capacity as owners, ensuring transparency in equity changes. Cash flow information is another critical component, offering insights into how the entity generates and uses cash. Together with the accompanying notes, this information helps users assess the entity's financial stability and predict future cash flows, particularly in terms of their timing and certainty. A complete set of financial statements provides a comprehensive overview of an entity's financial position and performance over a given period. It includes a statement of financial position, which presents the entity's assets, liabilities, and equity at the end of the reporting period. The statement of profit or loss and other comprehensive income summarizes the entity's financial performance, including revenues, expenses, gains, and losses. The statement of changes in equity tracks movements in equity, reflecting contributions from and distributions to owners, as well as retained earnings and other reserves. The statement of cash flows outlines cash inflows and outflows, offering insights into the entity's liquidity and financial health. Additionally, the notes to the financial statements provide essential accounting policy information and explanatory details, ensuring clarity and transparency for users. A complete set of financial statements also includes comparative information for the preceding period, allowing users to analyze financial trends and assess changes over time. Additionally, when an entity applies an accounting policy retrospectively, makes a retrospective restatement, or reclassifies items in its financial statements, it must present a statement of financial position at the beginning of the preceding period. This ensures transparency and consistency in financial reporting. Entities have flexibility in naming these statements as long as the meaning remains clear. For instance, the statement of profit or loss and other comprehensive income may be referred to as the statement of comprehensive income based on the entity's preferred terminology. An entity has the option to present a single statement that combines profit or loss and other comprehensive income, structured into two sections. In this format, the profit or loss section appears first, followed directly by the other comprehensive income section. Alternatively, an entity may choose to present the profit or loss section separately in a distinct statement. In such cases, the separate statement of profit or loss must immediately precede the statement of comprehensive income, which will begin with the profit or loss figure. Regardless of the presentation format chosen, all financial statements within a complete set must be given equal prominence to ensure clarity and consistency in financial reporting. Many entities provide a financial review by management alongside their financial statements. This review serves to describe and explain key aspects of the entity's financial performance and position, while also highlighting the principal uncertainties it faces. Typically, it includes an analysis of the main factors influencing financial performance, such as shifts in the business environment, the entity's responses to those changes, and their impact. Additionally, it may outline the entity's investment policies aimed at sustaining and improving financial performance, including its approach to dividends. The review can also provide insights into the entity's funding sources and its targeted debt-to-equity ratio. Furthermore, it may discuss valuable resources that are not recognized in the Statement of Financial Position under IFRS, offering a broader perspective on the entity's overall financial health. In addition to financial statements, many entities provide supplementary reports, such as environmental reports and value-added statements. These are particularly common in industries where environmental considerations play a crucial role or where employees are recognized as a key stakeholder group. These reports offer insights into sustainability efforts, corporate social responsibility, and the overall impact of the entity's operations beyond financial performance. However, it is important to note that such reports and statements fall outside the scope of IFRS, meaning they are not subject to the same reporting standards and requirements as financial statements. Instead, they serve as additional disclosures that help stakeholders gain a more comprehensive understanding of the entity's broader economic, social, and environmental impact. Financial statements must provide a fair presentation of an entity's financial position, performance, and cash flows. This means that they should faithfully represent the effects of transactions, events, and conditions in line with the definitions and recognition criteria outlined in the conceptual framework for financial reporting. Compliance with IFRS ensures that financial statements achieve this fair presentation, with additional disclosures provided when necessary. An entity that fully complies with IFRS must explicitly state this compliance in the notes to the financial statements. However, partial compliance is not sufficient. An entity cannot claim to follow IFRS unless it meets all the applicable requirements. This ensures transparency and reliability, giving stakeholders confidence in the accuracy and integrity of the financial information presented. Achieving a fair presentation under IFRS requires more than just following the standards. It also involves applying sound judgment to ensure financial statements are useful and meaningful. To achieve this, an entity must follow IAS 8 when selecting and applying accounting policies, ensuring consistency in financial reporting. If no specific IFRS applies to a particular item, management must follow a hierarchy of authoritative guidance to determine the appropriate treatment. Present information clearly so that it is relevant, reliable, comparable, and understandable. This includes properly disclosing accounting policies and ensuring that users can interpret financial statements without confusion. Provide additional disclosures whenever IFRS requirements alone do not fully explain the financial impact of certain transactions, events, or conditions. This ensures that users have all necessary information to understand the entity's financial position and performance. Ultimately, financial statements should not only comply with IFRS, but also serve their primary purpose: to provide meaningful insights that help users make informed economic decisions. An entity cannot rectify inappropriate accounting policies simply by disclosing them in the notes or through explanatory material. Financial statements must present information that is accurate and complies with IFRS, rather than just being transparent about non-compliance. In extremely rare cases where management determines that applying a specific IFRS requirement would be so misleading that it conflicts with the objective of financial statements, the entity is allowed to depart from that requirement, provided that the relevant regulatory framework permits or does not prohibit such a departure. If such an exception is applied, the entity must clearly disclose the nature of the departure, explain why compliance would have been misleading, and describe the alternative approach used, ensuring transparency while maintaining the reliability and relevance of financial information. When an entity departs from a requirement of an IFRS, it must disclose that management has concluded the financial statements present a fair view of the entity's financial position, financial performance, and cash flows. It must also state that while it has complied with applicable IFRSs, it has departed from a specific requirement to achieve fair presentation. The entity must identify the IFRS title, describe the nature of the departure, explain the prescribed treatment, and why following it would be misleading to the point of conflicting with the objective of financial statements as set out in the conceptual framework, and detail the alternative treatment used. Additionally, for each period presented, the entity must disclose the financial impact of the departure on each affected item in the financial statements, ensuring full transparency regarding its effects. When an entity has departed from a requirement of an IFRS in a prior period, and this departure impacts the amounts recognized in the current period's financial statements, it must provide the necessary disclosures. This requirement applies in cases where a previous departure from an IFRS, such as one related to the measurement of assets or liabilities, influences the measurement of change in those assets and liabilities in the current period. By ensuring such disclosures, the entity maintains transparency and allows users of financial statements to understand the implications of past departures on the present financial reporting. In extremely rare cases where management determines that compliance with a specific IFRS requirement would be so misleading that it conflicts with the objective of financial statements set out in the conceptual framework, but the relevant regulatory framework does not allow departure from the requirement, the entity must take steps to minimize the misleading aspects of compliance. This includes disclosing the title of the IFRS in question, the nature of the requirement, and the reasons why management believes compliance would be misleading. Additionally, for each period presented, the entity should disclose the adjustments to each item in the financial statements that management considers necessary to achieve a fair presentation. An item of information conflicts with the objective of financial statements if it fails to faithfully represent the transactions, events, and conditions it is meant to depict, potentially affecting users' economic decisions. When evaluating whether compliance with a specific IFRS requirement would be so misleading that it contradicts the objective of financial statements set out in the conceptual framework, management must consider why the objective is not achieved in the given circumstances and how the entity's situation differs from others that comply with the requirement. If other entities in similar conditions adhere to the requirement, there is a rebuttable presumption that compliance would not be so misleading as to conflict with the objective of financial statements. When preparing financial statements, management must assess the entity's ability to continue as a going concern. Financial statements should be prepared on a going concern basis unless management intends to liquidate the entity, cease trading, or has no realistic alternative but to do so. If management identifies material uncertainties that could cast significant doubt on the entity's ability to continue as a going concern, those uncertainties must be disclosed. If financial statements are not prepared on a going concern basis, the entity must disclose this fact, along with the basis used for preparation and the reasons why it is not considered a going concern. When assessing the appropriateness of the going concern assumption, management considers all available information about the future, covering at least 12 months from the end of the reporting period. The extent of this assessment depends on the specific circumstances of the entity. If an entity has a history of profitability and easy access to financial resources, it may conclude that the going concern basis is appropriate without extensive analysis. However, in other cases, management must evaluate various factors, including current and expected profitability, debt repayment schedules, and potential sources of replacement financing to determine whether the going concern assumption remains valid. Under the accrual basis of accounting, an entity prepares its financial statements, except for cash flow information, by recognizing items such as assets, liabilities, equity, income, and expenses when they meet the definitions and recognition criteria outlined in the conceptual framework. This approach ensures that financial transactions are recorded when they occur, rather than when cash is received or paid, providing a more accurate representation of the entity's financial position and performance over time. Except when IFRS's permit or require otherwise, an entity shall present comparative information for the preceding period for all amounts reported in the current period's financial statements. Comparative information must also be included for narrative and descriptive details if relevant to understanding the current period's financial statements. At a minimum, an entity shall present 2 statements of financial position, 2 statements of profit or loss and other comprehensive income, 2 separate statements of profit or loss, if applicable, 2 statements of cash flows, 2 statements of changes in equity, and related notes. In certain cases, narrative information from the financial statements of prior periods remains relevant in the current period. For example, if an entity previously disclosed a legal dispute with an uncertain outcome at the end of the preceding period, and the matter is still unresolved, it should continue to provide relevant details. Users benefit from understanding that the uncertainty existed at the prior reporting date and from updates on any steps taken during the period to resolve the matter. An entity is allowed to present additional comparative information beyond the minimum required by IFRSs, provided that this information complies with IFRS standards. This additional comparative information can include 1 or more financial statements, but it does not need to constitute a full set of financial statements. When presenting such additional statements, the entity must also provide related notes to ensure clarity and completeness. For instance, an entity may choose to present a third statement of profit or loss and other comprehensive income, thereby including the current period, the preceding period, and one additional comparative period. However, it is not required to present a third statement of financial position, a third statement of cash flows, or a third statement of changes in equity. Instead, the entity must disclose the comparative information related to the additional statement of profit or loss and other comprehensive income in the notes to the financial statements. When an entity applies a change in accounting policy retrospectively, makes a retrospective restatement, or reclassifies items in its financial statements, and this has a material impact on the information presented, it must provide an additional comparative statement of financial position as at the beginning of the preceding period. This third statement, along with the usual 2 comparative periods, ensures users can clearly see the effects of these changes on the entity's financial position over time. In cases where an entity applies a new accounting policy retrospectively, makes a retrospective restatement, or reclassifies items in a way that materially affects the financial statements, it must present 3 statements of financial position. At the end of the current period, at the end of the preceding period, and at the beginning of the preceding period. While the entity must disclose the necessary information required by IAS 8, it is not required to provide related notes for the opening statement of financial position at the beginning of the preceding period. When an entity changes the presentation or classification of items in its financial statements, it must reclassify comparative amounts unless it is impracticable to do so. In such cases, the entity is required to disclose the following information, including for the beginning of the preceding period: the nature of the reclassification, the amount of each item or class of items that is being reclassified, and the reason for the reclassification. This ensures transparency and allows users to understand the impact of changes on the financial statements. When it is impracticable to reclassify comparative amounts, an entity must disclose the reason for not reclassifying the amounts and the nature of the adjustments that would have been made if the amounts had been reclassified. These disclosures help users understand the limitations on comparability between periods and allow them to assess how the changes may affect their economic decisions. For example, if an entity did not collect the necessary data in prior periods in a way that would allow for reclassification, it may be impossible to recreate that information. IAS 8 provides guidance on the adjustments required when an entity changes an accounting policy or corrects an error, ensuring that users of financial statements can still make informed decisions despite these challenges. An entity is required to maintain the consistency of presentation and classification of items in its financial statements from one period to the next, unless there is a significant change in the nature of the entity's operations or a review of its financial statements reveals that a different presentation or classification would be more appropriate. This change must be made in accordance with the criteria for selecting and applying accounting policies as outlined in IAS 8. Additionally, an entity must change its presentation if an IFRS specifically mandates such a change. Consistency in presentation is important for users to make reliable comparisons over time. For instance, a significant acquisition or disposal, or even a review of the financial statements presentation, could indicate that a different presentation is necessary. An entity should change the presentation of its financial statements only if the new format provides more reliable and relevant information for the users. The revised structure should also be sustainable, ensuring that comparability is not compromised. When such changes in presentation occur, the entity must reclassify its comparative information to maintain consistency and clarity in financial reporting. In this section, we will discuss the structure and content of financial statements as per the International Financial Reporting Standards. This standard outlines specific disclosure requirements in the Statement of Financial Position, the statements of profit or loss, and other comprehensive income, or the Statement of Changes in Equity. It also stipulates that other line items may need to be disclosed either in these statements or in the accompanying notes. Furthermore, IAS 7, which deals with the statement of cash flows, provides guidelines for presenting cash flow information. The term disclosure in this context is used in a broad sense, referring not only to information presented in the financial statements themselves, but also to the required additional details that provide a fuller picture of the financial performance and position of the entity. Disclosures can also be mandated by other IFRSs. In the absence of a specific directive in the standard or other IFRSs, these disclosures can be included within the financial statements. This ensures transparency and provides users with the necessary information to make informed decisions. An entity must clearly identify its financial statements and distinguish them from other information within the same published document. This is crucial because IFRSs apply specifically to financial statements, not necessarily to other content within an annual report, regulatory filing, or similar document. It is important for users to be able to differentiate between information prepared in compliance with IFRSs and other information that, while useful, may not be subject to these standards. Each financial statement and the accompanying notes should be clearly identified. Furthermore, the entity must prominently display certain information and, if necessary, repeat it to ensure that the information is understandable. This practice enhances transparency and helps users clearly identify the relevant financial data. The financial statements must clearly identify the name of the reporting entity or another means of identification, along with any changes in this information from the end of the preceding reporting period. They should also specify whether the financial statements are for an individual entity or a group of entities. Additionally, the date at the end of the reporting period or the period covered by the financial statements or notes must be provided. The presentation currency, as defined in IAS 21, should be stated, and the level of rounding used in presenting amounts in the financial statements must be disclosed. These details are crucial for providing context and ensuring clarity for users of the financial statements. An entity meets the requirements of financial statement presentation by using appropriate headings for pages, statements, notes, and columns, requiring judgment in determining the best way to present the information. For instance, when financial statements are presented electronically, separate pages may not always be used, but the entity must ensure that all items are clearly presented to allow users to understand the content. To enhance the clarity of the financial statements, entities often present amounts in thousands or millions of the presentation currency. This practice is acceptable as long as the entity discloses the level of rounding and ensures that no material information is omitted. The statement of financial position must include line items that present various amounts to provide a comprehensive view of the entity's financial position. These line items should include property, plant, and equipment, investment property, intangible assets, financial assets, portfolios of contracts within the scope of IFRS 17 that are assets, and investments accounted for using the equity method. These items are essential for presenting the financial standing of the entity, offering detailed insights into its assets, investments, and long-term resources. The statement of financial position should also include the following line items: biological assets within the scope of IAS 41 agriculture, inventories, trade and other receivables, cash and cash equivalents, the total of assets classified as held for sale and assets included in disposal groups classified as held for sale, in accordance with IFRS 5 non-current assets held for sale and discontinued operations, trade and other payables, provisions, financial liabilities, and portfolios of contracts within the scope of IFRS 17 that are liabilities. These items reflect both the financial position and obligations of the entity, allowing for a complete and transparent presentation of its resources, debts, and commitments. The statement of financial position should also include liabilities and assets for current tax, deferred tax liabilities, and deferred tax assets, liabilities included in disposal groups classified as held for sale in accordance with IFRS 5, non-controlling interest presented within equity, and issued capital and reserves attributable to owners of the parent. Additionally, an entity is required to present other line items, headings, and subtotals in the statement of financial position when they are deemed relevant to provide a clearer and more comprehensive understanding of the entity's financial position. This ensures that the financial statement offers meaningful insight into the entity's assets, liabilities, equity, and overall financial standing. When an entity presents subtotals in the statement of financial position, these subtotals must be comprised of line items that are recognized and measured in accordance with IFRS. The subtotals should be clearly presented and labeled, ensuring that the line items that constitute them are understandable. The presentation of these subtotals should remain consistent from period to period to ensure comparability. Furthermore, the prominence of the subtotals should not exceed that of the required totals and subtotals mandated by IFRS for the statement of financial position. In cases where an entity separates current and non-current assets and current and non-current liabilities in its financial position, it must ensure that deferred tax assets and liabilities are not classified as current assets or liabilities. This ensures the accurate reflection of the nature of these items in accordance with the standard. This standard does not prescribe a specific order or format for presenting items in the statement of financial position. It focuses on identifying items that are significantly different in nature or function and therefore warrant separate presentation. Line items should be included when the size, nature, or function of an item or an aggregation of similar items makes separate presentation essential for understanding the entity's financial position. Additionally, the descriptions used and the ordering of items or similar items may be adjusted to reflect the nature of the entity and its transactions, ensuring the presentation provides relevant information for understanding the entity's financial position. For instance, a financial institution may modify these descriptions to provide more relevant information specific to its operations. An entity must exercise judgment when deciding whether to present additional items separately in the financial statements. This judgment is based on an assessment of the nature and liquidity of assets, the function of assets within the entity, and the amounts, nature, and timing of liabilities. The use of different measurement bases for various classes of assets indicates that their nature or function differs, which justifies their presentation as separate line items. For example, different classes of property, plant, and equipment may be carried at either cost or revalued amounts in accordance with IAS 16, and this distinction would necessitate separate presentation. An entity is required to present current and non-current assets, as well as current and non-current liabilities, as separate classifications in its statement of financial position. However, an exception is made if a presentation based on liquidity provides more reliable and relevant information. In such cases, the entity should present all assets and liabilities in order of liquidity. Regardless of the presentation method chosen, the entity must disclose the amount expected to be recovered or settled after more than 12 months for each asset and liability line item that combines amounts expected to be recovered or settled within or beyond 12 months. When an entity supplies goods or services within a clearly identifiable operating cycle, presenting current and non-current assets and liabilities separately in the statement of financial position provides valuable information. This classification distinguishes the net assets that are continuously circulating as working capital from those used in the entity's long-term operations. It also highlights assets expected to be realized within the current operating cycle and liabilities due for settlement within the same period. This distinction helps users understand how the entity manages its short-term and long-term financial obligations and resources. For certain entities, particularly financial institutions, presenting assets and liabilities in increasing or decreasing order of liquidity may provide more reliable and relevant information than using the current/non-current classification. This is especially true for entities that do not supply goods or services within a clearly identifiable operating cycle. Additionally, an entity may choose to combine both approaches, presenting some assets and liabilities using the current/non-current classification, while others are presented in order of liquidity, if this mixed presentation offers more relevant and reliable information. This approach is often necessary for entities with diverse operations that require different presentation methods to reflect their unique financial structures accurately. Information about the expected dates of realization of assets and liabilities plays a crucial role in evaluating an entity's liquidity and solvency. IFRS 7. Financial instruments disclosures mandates the disclosure of maturity dates for financial assets and liabilities. These include financial assets such as trade and other receivables, as well as financial liabilities like trade and other payables. Moreover, details regarding the expected recovery dates for non-monetary assets like inventories and the expected settlement dates for liabilities such as provisions are also important. This information is useful regardless of whether the assets and liabilities are classified as current or non-current. For instance, an entity should disclose the portion of inventories expected to be recovered more than 12 months after the reporting period, providing insight into the entity's long-term asset management and liquidity position. An entity must classify an asset as current if it expects to realize the asset or intends to sell or consume it within its normal operating cycle. Additionally, an asset is considered current if it is held primarily for the purpose of trading, or if the entity expects to realize the asset within 12 months after the reporting period. Cash or a cash equivalent is also classified as current unless it is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. Any other assets that do not meet these criteria should be classified as non-current. This standard uses the term non-current to refer to tangible, intangible, and financial assets that have a long-term nature. However, it does not prohibit the use of alternative descriptions as long as the meaning remains clear. The operating cycle of an entity is the period between the acquisition of assets for processing and their realization in cash or cash equivalents. If the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. Current assets include those such as inventories and trade receivables that are sold, consumed, or realized as part of the normal operating cycle, even if they are not expected to be realized within 12 months after the reporting period. Current assets also include assets held primarily for trading purposes, such as certain financial assets defined as held for trading under IFRS 9, and the current portion of non-current financial assets. An entity shall classify a liability as current when it expects to settle the liability in its normal operating cycle, holds the liability primarily for trading purposes, or when the liability is due to be settled within 12 months after the reporting period. Additionally, a liability is classified as current if the entity does not have the right at the end of the reporting period to defer settlement of the liability for at least 12 months after the reporting period. All other liabilities should be classified as non-current. Some current liabilities, like trade payables and certain accruals for employee and other operating costs, are considered part of the working capital used in an entity's normal operating cycle. These operating items are classified as current liabilities, even if they are due to be settled more than 12 months after the reporting period. The same normal operating cycle principle applies when classifying both assets and liabilities. If an entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. Other current liabilities are those that are not settled as part of the normal operating cycle, but are due for settlement within 12 months after the reporting period, or held primarily for trading purposes. Examples include certain financial liabilities that meet the definition of held for trading under IFRS 9, bank overdrafts, the current portion of non-current financial liabilities, dividends payable, income taxes, and other non-trade payables. Financial liabilities that provide long-term financing, that is, those not part of the working capital in the entity's normal operating cycle, and are not due for settlement within 12 months after the reporting period, are classified as non-current liabilities. An entity classifies its financial liabilities as current when they are due to be settled within 12 months after the reporting period, even if the original term was for a period longer than 12 months. This classification applies regardless of any agreement to refinance or reschedule payments on a long-term basis, provided such an agreement is completed after the reporting period, but before the financial statements are authorized for issue. An entity's right to defer settlement of a liability for at least 12 months after the reporting period must have substance and exist at the end of the reporting period. In the case of a loan arrangement, the right to defer settlement may depend on meeting specific conditions known as covenants outlined in the loan agreement. For classification purposes, covenants affect whether the right to defer settlement exists at the end of the reporting period if the entity is required to comply with the covenant on or before the reporting period's end, even if compliance is assessed after the reporting period. For example, a covenant based on the entity's financial position at the end of the reporting period. However, covenants do not affect whether the right exists at the end of the reporting period if compliance with the covenant is required only after the reporting period. For example, a covenant based on the entity's financial position 6 months after the reporting period. If an entity has the right at the end of the reporting period to roll over an obligation for at least 12 months under an existing loan facility, it classifies the obligation as non-current even if it would otherwise be due within a shorter period. However, if the entity does not have this right, it does not consider the potential to refinance the obligation and classifies it as current. In situations where an entity breaches a covenant of a long-term loan arrangement on or before the end of the reporting period, resulting in the liability becoming payable on demand, the entity must classify the liability as current. This applies even if the lender agrees after the reporting period and before the financial statements are authorized for issue, not to demand payment due to the breach. The classification as current occurs because at the end of the reporting period, the entity does not have the right to defer settlement of the liability for at least 12 months after that date. An entity classifies a liability as non-current if the lender agrees by the end of the reporting period to provide a period of grace, which ends at least 12 months after the reporting period. During this period, the entity can rectify the breach and the lender cannot demand immediate repayment. The classification of a liability is not affected by the likelihood that the entity will exercise its right to defer settlement of the liability for at least 12 months after the reporting period. If a liability meets the criteria for classification as non-current, it is classified as non-current, even if management intends or expects the entity to settle the liability within 12 months after the reporting period, or even if the entity settles the liability between the end of the reporting period and the date the financial statements are authorized for issue. In such cases, the entity may need to disclose information about the timing of settlement to help users of the financial statements understand the impact of the liability on the entity's financial position. According to IAS 10, events after the reporting period, if certain events occur between the end of the reporting period and the date the financial statements are authorized for issue, they are disclosed as non-adjusting events. These events include the refinancing on a long-term basis of a liability that was classified as current, the rectification of a breach of a long-term loan arrangement that was classified as current, the granting by the lender of a period of grace to rectify a breach of a long-term loan arrangement classified as current, and the settlement of a liability classified as non-current. These events do not result in adjustments to the financial statements since they reflect conditions that arose after the reporting period, but they must be disclosed to provide users with full and accurate information about the entity's financial position. When determining the classification of liabilities arising from loan arrangements, an entity may classify them as non-current if the right to defer settlement depends on the entity's compliance with covenants within 12 months after the reporting period. In such cases, the entity is required to disclose relevant information in the notes to the financial statements to help users understand the risk that the liabilities may become repayable within 12 months. This disclosure should include details about the covenants, such as their nature, the time frame in which the entity must comply with them, and the carrying amount of the related liabilities. This helps provide transparency regarding potential risks and the conditions under which the liabilities might become current. In addition to the information about the covenants and their related liabilities, the entity must also disclose any facts and circumstances that could indicate potential difficulty in complying with the covenants. For example, if the entity has taken actions during or after the reporting period to prevent or reduce the risk of breaching the covenants, this should be disclosed. Similarly, the entity must disclose situations where it would have failed to comply with the covenants if they had been assessed based on the circumstances at the end of the reporting period. Such disclosures are important for users of financial statements to understand the risks and actions taken by the entity to manage covenant compliance. For the purpose of classifying a liability as current or non-current, settlement is defined as a transfer to the counterparty that results in the extinguishment of the liability. This transfer can take the form of cash or other economic resources, such as goods or services. It may also involve the entity's own equity instruments. In cases where the terms of a liability allow the counterparty to choose settlement through the transfer of the entity's own equity instruments, the classification of the liability as current or non-current is not affected, provided that in line with IAS 32 Financial Instruments presentation, the entity classifies this option as an equity instrument and recognizes it separately from the liability as an equity component of a compound financial instrument. An entity is required to disclose further subclassifications of the line items presented in its statement of financial position or in the notes based on a classification that is appropriate for its operations. The level of detail in these subclassifications is determined by the requirements of IFRSs and the size, nature, and function of the amounts involved. The disclosures may vary for each item. For example, property, plant, and equipment are disaggregated into classes as per IAS 16. Receivables are separated into amounts due from trade customers, receivables from related parties, prepayments, and other amounts. Inventories are categorized under classifications such as merchandise, production supplies, materials, work in progress, and finished goods, as outlined in IAS 2. Provisions are split between provisions for employee benefits and other items, and equity capital and reserves are broken down into categories like paid-in capital, share premium, and reserves. An entity is required to disclose specific information about its share capital, either in the statement of financial position, the statement of changes in equity, or in the notes. For each class of share capital, the entity must provide details such as the number of authorized shares, the number of shares issued and fully paid, and those issued but not fully paid. It must also disclose the par value per share or indicate that the shares have no par value, along with a reconciliation of the number of shares outstanding at the beginning and end of the period. Additionally, the rights, preferences, and restrictions attached to each class of shares, including any limitations on dividend distribution and capital repayment, must be outlined. The entity should also disclose information regarding shares held by the entity or its subsidiaries or associates, as well as shares reserved for issue under options and contracts for the sale of shares, including terms and amounts. Furthermore, a description of the nature and purpose of each reserve within equity should be provided. For entities without share capital, such as partnerships or trusts, the disclosure should show changes in each category of equity interest during the period and the rights, preferences, and restrictions attached to each category. If an entity has reclassified a puttable financial instrument that was classified as an equity instrument, or an instrument that imposes on the entity an obligation to deliver to another party a pro rata share of the net assets of the entity only on liquidation, and is classified as an equity instrument between financial liabilities and equity, it must disclose the amount reclassified into and out of each category, financial liabilities or equity. The entity is also required to provide details regarding the timing and the reason for the reclassification. The statement of profit or loss and other comprehensive income, also known as the statement of comprehensive income, shall include, in addition to the profit or loss and other comprehensive income sections, the profit or loss, total other comprehensive income, and comprehensive income for the period, which is the total of profit or loss and other comprehensive income. If an entity presents a separate statement of profit or loss, it is not required to present the profit or loss section in the statement of comprehensive income. The statement of profit or loss and other comprehensive income requires an entity to present, in addition to the profit or loss and other comprehensive income sections, an allocation of profit or loss and other comprehensive income for the period. This allocation includes profit or loss for the period attributable to non-controlling interests and owners of the parent, as well as comprehensive income for the period attributable to non-controlling interests and owners of the parent. If an entity presents profit or loss in a separate statement, it shall ensure that this allocation is included in that statement. In addition to items required by other IFRSs, the profit or loss section or the statement of profit or loss shall include line items presenting the following amounts for the period. Revenue, which must separately present interest revenue calculated using the effective interest method and insurance revenue. Gains and losses arising from the derecognition of financial assets measured at amortized cost. Insurance service expenses from contracts issued within the scope of IFRS 17. income or expenses from reinsurance contracts held, finance costs, impairment losses, including reversals of impairment losses or impairment gains, insurance finance income or expenses from contracts issued within the scope of IFRS 17, finance income or expenses from reinsurance contracts held, the share of the profit or loss of associates and joint ventures accounted for using the equity method, any gain or loss arising from the reclassification of a financial asset out of the amortized cost measurement category or the fair value through other comprehensive income measurement category into fair value through profit or loss, tax expense, and a single amount for the total of discontinued operations. The other comprehensive income section shall present line items for the amounts for the period, classified by nature, and grouped into those that, in accordance with other IFRSs, will not be reclassified subsequently to profit or loss, and those that will be reclassified subsequently to profit or loss when specific conditions are met. Additionally, the share of the other comprehensive income of associates and joint ventures accounted for using the equity method should be presented separated into the share of items that, in accordance with other IFRSs, will not be reclassified subsequently to profit or loss, and those that will be reclassified subsequently to profit or loss when specific conditions are met. An entity shall present additional line items, headings, and subtotals in the statements presenting profit or loss and other comprehensive income when such presentation is relevant to understanding the entity's financial performance. When presenting subtotals, those subtotals must be comprised of line items made up of amounts recognized and measured in accordance with IFRS, and be presented and labeled in a manner that makes the line items constituting the subtotal clear and understandable. An entity must ensure that subtotals presented in the statements of profit or loss and other comprehensive income are consistent from period to period. Additionally, these subtotals should not be displayed with more prominence than the subtotals and totals required by IFRS for such statements. The entity must also present line items in the statements of profit or loss and other comprehensive income that reconcile any subtotals presented with the subtotals or totals required by IFRS. Disclosing the components of financial performance is important because the effects of an entity's various activities, transactions, and events differ in frequency, potential for gain or loss, and predictability. This disclosure helps users understand the financial performance achieved and make projections of future financial performance. An entity may include additional line items in the statements, presenting profit or loss, and other comprehensive income and adjust the descriptions and ordering of items when it is necessary to clarify the elements of financial performance. Factors such as materiality and the nature and function of income and expense items should be considered. For example, a financial institution may change the descriptions to reflect operations that are specific to the financial sector. However, an entity is prohibited from offsetting income and expense items unless the specified criteria are met. Additionally, extraordinary items should not be presented in the statements presenting profit or loss and other comprehensive income or in the notes. An entity must recognize all items of income and expense for a period in profit or loss, unless a specific IFRS requires or permits otherwise. Some IFRSs set out situations in which an entity should recognize certain items outside profit or loss in the current period. For example, IAS 8 specifies two such situations: the correction of errors and the effect of changes in accounting policies. Additionally, other IFRSs may require or allow components of other comprehensive income, which meet the conceptual framework's definition of income or expense, to be excluded from profit or loss. An entity must disclose the amount of income tax relating to each item of other comprehensive income, including reclassification adjustments, either in the statement of profit or loss, and other comprehensive income or in the notes. The entity has the option to present items of other comprehensive income, either net of related tax effects or before tax effects, with one amount shown for the aggregate amount of income tax related to those items. If the entity chooses the latter option, it must allocate the tax between items that may be reclassified to profit or loss and those that will not be reclassified to profit or loss. An entity must disclose reclassification adjustments related to components of other comprehensive income. Other IFRSs provide guidance on when amounts previously recognized in other comprehensive income are reclassified to profit or loss, known as reclassification adjustments. A reclassification adjustment is included with the related component of other comprehensive income in the period when the adjustment is reclassified to profit or loss. These amounts may have been recognized as unrealized gains in the current or previous periods, and such unrealized gains must be deducted from other comprehensive income in the period when the realized gains are reclassified to profit or loss to prevent them from being included in total comprehensive income twice. An entity may present reclassification adjustments either in the statements of profit or loss and other comprehensive income or in the notes. If the reclassification adjustments are presented in the notes, the entity must present the items of other comprehensive income after any related reclassification adjustments. Reclassification adjustments occur, for example, upon the disposal of a foreign operation, or when some hedged forecast cash flows impact profit or loss. Reclassification adjustments do not arise from changes in the revaluation surplus recognized under IAS 16 or IAS 38, nor from remeasurements of defined benefit plans recognized under IAS 19. These components are recognized in other comprehensive income and are not reclassified to profit or loss in subsequent periods. However, changes in the revaluation surplus may be transferred to retained earnings in future periods as the asset is used or when it is derecognized. According to IFRS 9, reclassification adjustments also do not arise if a cash flow hedge, or the accounting for the time value of an option, or the forward element of a forward contract, or the foreign currency basis spread of a financial instrument, results in amounts being removed from the cash flow hedge reserve or a separate component of equity, and included directly in the initial cost or other carrying amount of an asset or liability. These amounts are transferred directly to the assets or liabilities. When items of income or expense are material, an entity shall disclose their nature and amount separately. Circumstances that would require separate disclosure of income and expense items include write-downs of inventories to net realizable value or of property, plant, and equipment to recoverable amount, along with reversals of such write-downs. It also includes restructurings of the entity's activities and reversals of any provisions for restructuring costs, disposals of items of property, plant, and equipment, and disposals of investments. These disclosures are intended to provide clarity and transparency about the nature and impact of material items that affect the entity's financial performance. An entity is required to separately disclose items such as discontinued operations, litigation settlements, and other reversals of provisions when they are material. Additionally, an entity shall present an analysis of expenses recognized in profit or loss based on either their nature or their function within the entity, depending on which classification provides the most reliable and relevant information. Entities are encouraged to provide this analysis in the statements of profit or loss and other comprehensive income. The classification of expenses is done to highlight components of financial performance that may differ in terms of frequency, potential for gain or loss, and predictability. This analysis can be presented in one of two forms, providing further transparency and insight into the financial results of the entity. The first form of analysis, known as the nature of expense method, involves aggregating expenses within profit or loss based on their nature, such as depreciation, purchases of materials, transport costs, employee benefits, and advertising costs, without reallocating them among functions within the entity. This method is typically simpler to apply since it does not require allocating expenses to specific functions. An example of this classification might present items such as revenue, other income, changes in inventories of finished goods and work in progress, raw materials and consumables used, employee benefits expense, depreciation and amortization expense, and other expenses. The total expenses are then calculated, leading to the determination of profit before tax. This approach provides a clear and straightforward breakdown of income and expenses by their nature, culminating in the profit before tax. The second form of analysis, the function of expense or cost of sales method, classifies expenses based on their function, such as cost of sales, distribution costs, or administrative expenses. This method provides more relevant information to users than the nature of expense method by grouping expenses according to the specific functions they serve within the entity. However, allocating costs to these functions may require arbitrary allocations and involve significant judgment. Under this method, at a minimum, an entity must disclose its cost of sales separately from other expenses. An example of this classification might show items such as revenue, cost of sales, and gross profit, followed by other income, distribution costs, administrative expenses, and other expenses. The total expenses are then calculated, leading to the determination of profit before tax. This approach helps users understand the costs associated with various business functions and how they contribute to the entity's financial performance. When an entity classifies expenses by function, it must provide additional information on the nature of the expenses, such as depreciation and amortization expense, as well as employee benefits expense. The decision between using the function of expense method and the nature of expense method depends on factors such as the entity's history, industry practices, and its specific nature. Both methods offer insights into costs that might fluctuate in relation to the entity's sales or production levels. Given that each method has its advantages depending on the type of entity, this standard requires management to choose the one that provides the most reliable and relevant information. However, since understanding the nature of expenses is crucial for forecasting future cash flows, additional disclosures are mandated when the function of expense classification is used. An entity is required to present a statement of changes in equity, which should include specific information. This includes total comprehensive income for the period, with separate disclosure of the total amounts attributable to the owners of the parent and to non-controlling interests. Additionally, the statement must show the effects of retrospective application or retrospective restatement recognized in accordance with IAS 8 for each component of equity. The reference to item has been deleted and is no longer applicable. In the statement of changes in equity, an entity must also provide a reconciliation for each component of equity, showing the carrying amount at the beginning and the end of the period. This reconciliation should separately disclose changes resulting from profit or loss, other comprehensive income, and transactions with owners in their capacity as owners, including contributions by and distributions to owners, as well as changes in ownership interests in subsidiaries that do not result in a loss of control. In the statement of changes in equity or in the notes, an entity must present an analysis of other comprehensive income by item for each component of equity. Additionally, the entity is required to disclose the amount of dividends recognized as distributions to owners during the period, along with the related amount of dividends per share. The components of equity typically include each class of contributed equity, the accumulated balance of each class of other comprehensive income, and retained earnings. Changes in an entity's equity between the beginning and the end of the reporting period reflect the increase or decrease in its net assets during that period. These changes, apart from those resulting from transactions with owners in their capacity as owners, such as equity contributions, reacquisitions of the entity's own equity instruments, and dividends, represent the total amount of income and expense generated by the entity's activities. It includes all gains and losses that occurred during the period, which contribute to the overall change in equity. IAS 8 requires retrospective adjustments to reflect changes in accounting policies to the extent practicable, unless otherwise specified by the transition provisions in another IFRS. It also mandates restatements to correct errors, which must be applied retrospectively, again to the extent practicable. These retrospective adjustments and restatements are not considered changes in equity, but instead are adjustments to the opening balance of retained earnings, unless another IFRS specifies a retrospective adjustment to a different component of equity. Disclosure in the statement of changes in equity is required to show the total adjustment to each component of equity due to changes in accounting policies and corrections of errors. These adjustments must be disclosed for each prior period and the beginning of the current period. The statement of cash flows provides users with essential information to assess an entity's ability to generate cash and cash equivalents, as well as its need to utilize those cash flows. IAS 7 establishes the requirements for presenting and disclosing cash flow information. This information helps users understand how the entity generates and uses cash, which is vital for assessing its financial health, liquidity, and future financial obligations. The statement categorizes cash flows into three main activities: operating, investing, and financing, allowing for a clear picture of the entity's cash movements during the reporting period. The notes to the financial statements serve an important role in providing additional details and context to the main financial statements. They should include information about the basis of preparation of the financial statements and the specific accounting policies applied. Additionally, the notes should disclose any information required by IFRSs that is not presented elsewhere in the financial statements. They also provide any other relevant information not included elsewhere but necessary for a complete understanding of the financial statements, offering further insights into the entity's financial position and performance. An entity is required to present the notes to its financial statements in a systematic manner, ensuring that the organization of the notes enhances the understandability and comparability of the financial statements. When determining the systematic approach, the entity should consider how the arrangement will support users in comprehending the financial information. Each item presented in the statement of financial position, statements of profit or loss and other comprehensive income, statement of changes in equity, and statement of cash flows must be cross-referenced to any related details provided in the notes. This practice ensures that the relevant information is easily accessible and linked to the corresponding items in the financial statements. Examples of systematic ordering or grouping of the notes include various approaches to enhance the clarity and understandability of the financial statements. For instance, an entity may choose to give prominence to areas it deems most relevant for understanding its financial performance and position, such as grouping information about specific operating activities. Alternatively, the entity could group together information about items measured in similar ways, like assets measured at fair value. Another approach is to follow the order of the line items in the statements of profit or loss and other comprehensive income, as well as the statement of financial position, ensuring that the notes align with the structure of the financial statements. This can involve including a statement of compliance with IFRSs, detailing material accounting policies, and providing supporting information for line items in the financial statements. Additionally, the notes may include other disclosures such as contingent liabilities, unrecognized contractual commitments, and non-financial disclosures like the entity's financial risk management objectives and policies. In some cases, an entity may present the notes that cover the basis of preparation and accounting policies as a distinct section within the financial statements to further organize the information. An entity is required to disclose material accounting policy information. This information is considered material if, when evaluated in conjunction with other details in the financial statements, it could reasonably influence the decisions made by the primary users of those financial statements. The materiality of the accounting policies is determined by their potential impact on the user's understanding and decisions regarding the financial position and performance of the entity. Accounting policy information related to immaterial transactions, other events, or conditions is not required to be disclosed, as it does not significantly influence users' decisions. However, such information can still be material if the nature of the related transactions, events, or conditions is significant, even if the amounts are immaterial. On the other hand, not all accounting policy information connected to material transactions is automatically material in itself. Accounting policy information is generally deemed material if its disclosure helps users of the financial statements understand other material details within them. For instance, an entity would likely consider accounting policy information material if it pertains to significant transactions, events, or conditions that influence the overall understanding of the financial statements. The accounting policy was developed in accordance with IAS 8 in the absence of an IFRS that specifically applies, the entity is required to disclose it. Additionally, if the entity made significant judgments or assumptions in applying a particular accounting policy, especially in areas where those judgments or assumptions are essential to the financial statements, it must disclose such information. This includes instances where the entity has changed its accounting policy during the reporting period, resulting in a material impact on the financial statements, or if the entity chose one of the permissible accounting options under IFRS, such as opting to measure investment property at historical cost instead of fair value. In these cases, disclosing the reasons and the effect of the change or choice is necessary for clarity and transparency in financial reporting. When the accounting required for certain transactions, events, or conditions is complex, and users of the financial statements might not fully understand those items without additional context, it becomes necessary to disclose more detailed accounting policy information. This is particularly important when an entity applies multiple IFRSs to a class of material transactions, as the complexity of such situations could hinder user understanding. In these cases, accounting policy information that explains how the entity applies the IFRSs to its specific circumstances is more valuable to users than general standardized information or information that simply repeats or summarizes IFRS requirements. Moreover, if an entity discloses immaterial accounting policy information, it must ensure that such disclosures do not obscure or overshadow the material information. This ensures that the key details required to make informed decisions are clear and accessible to the users of the financial statements. An entity's decision that certain accounting policy information is immaterial does not exempt it from the related disclosure requirements specified in other IFRSs. Regardless of immateriality, any disclosures required by the applicable IFRSs must still be made. Furthermore, an entity must disclose alongside material accounting policy information or other relevant notes any judgments made by management during the process of applying accounting policies. These judgments, which do not involve estimations, must be those that have the most significant impact on the amounts recognized in the financial statements. In the process of applying the entity's accounting policies, management makes various judgments apart from those involving estimates that can significantly affect the amounts recognized in the financial statements. For example, management makes judgments in determining when substantially all the significant risks and rewards of ownership of financial assets, and for lessors, assets subject to leases are transferred to other entities. Whether, in substance, particular sales of goods are financing arrangements and therefore do not give rise to revenue, and whether the contractual terms of a financial asset give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. Some of the disclosures are required by other IFRSs. For example, IFRS 12, Disclosure of Interests in Other Entities, requires an entity to disclose the judgments it has made in determining whether it controls another entity. IAS 40, Investment Property, requires disclosure of the criteria developed by the entity to distinguish investment property from owner-occupied property and from property held for sale in the ordinary course of business when classification of the property is difficult. An entity shall disclose information about the assumptions it makes about the future and other major sources of estimation uncertainty at the end of the reporting period that have a significant risk of resulting in a material adjustment to the carrying amounts of assets and liabilities within the next financial year. In respect of those assets and liabilities, the notes shall include details of their nature and their carrying amount as at the end of the reporting period. Determining the carrying amounts of some assets and liabilities requires estimation of the effects of uncertain future events on those assets and liabilities at the end of the reporting period. For example, in the absence of recently observed market prices, future-oriented estimates are necessary to measure the recoverable amount of classes of property, plant, and equipment, the effect of technological obsolescence on inventories, provisions subject to the future outcome of litigation in progress, and long-term employee benefit liabilities such as pension obligations. These estimates involve assumptions about such items as the risk adjustment to cash flows or discount rates, future changes in salaries, and future changes in prices affecting other costs. The assumptions and other sources of estimation relate to the estimates that require management's most difficult, subjective, or complex judgments. As the number of variables and assumptions affecting the possible future resolution of the uncertainties increases, those judgments become more subjective and complex, and the potential for a consequential material adjustment to the carrying amounts of assets and liabilities normally increases accordingly. The disclosures are not required for assets and liabilities with a significant risk that their carrying amounts might change materially within the next financial year if, at the end of the reporting period, they are measured at fair value based on a quoted price in an active market for an identical asset or liability. Such fair values might change materially within the next financial year, but these changes would not arise from assumptions or other sources of estimation uncertainty at the end of the reporting period. An entity presents the disclosures in a manner that helps users of financial statements to understand the judgments that management makes about the future and about other sources of estimation uncertainty. The nature and extent of the information provided vary according to the nature of the assumption and other circumstances. Examples of the types of disclosures an entity makes are the nature of the assumption or other estimation uncertainty, the sensitivity of carrying amounts to the methods, assumptions, and estimates underlying their calculation, including the reasons for the sensitivity, the expected resolution of an uncertainty, and the range of reasonably possible outcomes within the next financial year in respect of the carrying amounts of the assets and liabilities affected, and an explanation of changes made to past assumptions concerning those assets and liabilities if the uncertainty remains unresolved. This standard does not require an entity to disclose budget information or forecasts in making the disclosures. Sometimes it is impracticable to disclose the extent of the possible effects of an assumption or another source of estimation uncertainty at the end of the reporting period. In such cases, the entity discloses that it is reasonably possible on the basis of existing knowledge that outcomes within the next financial year that are different from the assumption could require a material adjustment to the carrying amount of the asset or liability affected. In all cases, the entity discloses the nature and carrying amount of the specific asset or liability or class of assets or liabilities affected by the assumption. The disclosures of particular judgments that management made in the process of applying the entity's accounting policies do not relate to the disclosures of sources of estimation. Other IFRSs require the disclosure of certain assumptions that would otherwise need to be disclosed according to the relevant paragraph. For example, IAS 37 requires disclosure, in specified circumstances, of major assumptions concerning future events affecting classes of provisions. IFRS 13 fair value measurement requires disclosure of significant assumptions, including the valuation technique as, and inputs, the entity uses when measuring the fair values of assets and liabilities that are carried at fair value. An entity shall disclose information that enables users of its financial statements to evaluate the entity's objectives, policies, and processes for managing capital. This includes qualitative information about its objectives, policies, and processes for managing capital, such as a description of what it manages as capital, the nature of any externally imposed capital requirements, and how these are incorporated into capital management, and how it is meeting its objectives for managing capital. The entity also provides summary quantitative data about what it manages as capital, noting that some financial liabilities may be considered part of capital, while some components of equity may be excluded. Additionally, the entity discloses any changes in these aspects from the previous period, whether it complied with externally imposed capital requirements during the period, and the consequences of non-compliance if applicable. These disclosures are based on the information provided internally to key management personnel. An entity may manage capital in various ways and be subject to different capital requirements. For instance, a conglomerate may include entities engaged in insurance and banking activities across multiple jurisdictions. If an aggregate disclosure of capital requirements and capital management would not offer useful information or could distort a financial statement user's understanding of the entity's capital resources, the entity is required to disclose separate information for each capital requirement it is subject to. For puttable financial instruments classified as equity instruments, an entity shall disclose, to the extent not disclosed elsewhere, summary quantitative data about the amount classified as equity, its objectives, policies, and processes for managing its obligation to repurchase or redeem the instruments when required to do so by the instrument holders, including any changes from the previous period, the expected cash outflow on redemption or repurchase of that class of financial instruments, and information about how the expected cash outflow on redemption or repurchase was determined. An entity shall disclose in the notes the amount of dividends proposed or declared before the financial statements were authorized for issue, but not recognized as a distribution to owners during the period, and the related amount per share, and the amount of any cumulative preference dividends not recognized. An entity shall disclose the following, if not disclosed elsewhere in information published with the financial statements: the domicile and legal form of the entity, its country of incorporation, and the address of its registered office, or a principal place of business, if different from the registered office, a description of the nature of the entity's operations and its principal activities, the name of the parent and the ultimate parent of the group, and if it is a limited life entity, information regarding the length of its life. This section of the course will focus on transition and effective date. An entity shall apply this standard for annual periods beginning on or after the 1st of January 2009. Earlier application is permitted, and if an entity adopts this standard for an earlier period, it must disclose that fact. In 2008, IAS 27 was amended, specifically paragraph 106. This amendment should be applied for annual periods beginning on or after the 1st of July 2009. If an entity applies the amended IAS 27, 2008 for an earlier period, it must apply the amendment retrospectively. The amendments to IAS 32 and IAS 1, titled Puttable Financial Instruments and Obligations Arising on Liquidation, were issued in February 2008. These amendments amended paragraph 138 and inserted paragraphs 8A, 80A, and 136A. An entity is required to apply these amendments for annual periods beginning on or after the 1st of January 2009. Earlier application is permitted, and if an entity applies these amendments for an earlier period, it must disclose that fact and apply the related amendments to IAS 32, IAS 39, IFRS 7, and IFRIC 2, members' shares in cooperative entities and similar instruments, at the same time. Additionally, paragraphs 68 and 71 were amended by the improvements to IFRSs issued in May 2008. These amendments must be applied for annual periods beginning on or after the 1st of January 2009, with earlier application also permitted. If the amendments are applied for an earlier period, the entity must disclose that fact. Paragraphs 106 and 107 were amended, and paragraph 106A was added by the improvements to IFRSs issued in May 2010. An entity is required to apply these amendments for annual periods beginning on or after the 1st of January 2011, with earlier application permitted. IFRS 10 and IFRS 12, issued in May 2011, amended paragraphs 4, 119, 123, and 124. An entity must apply these amendments when it adopts IFRS 10 and IFRS 12. Similarly, IFRS 13, issued in May 2011, amended paragraphs 128 and 133. These amendments should be applied when the entity adopts IFRS 13. The presentation of items of other comprehensive income, amendments to IAS 1, issued in June 2011, amended paragraphs 7, 10, 82, 85, 87, 90, 91, 94, 100, and 115, added paragraphs 10A, 81A, 81B, and 82A, and deleted paragraphs 12, 81, 83, and 84. An entity must apply these amendments for annual periods beginning on or after the 1st of July 2012, with earlier application permitted. If an entity applies the amendments for an earlier period, it must disclose that fact. The IAS 19 Employee Benefits, as amended in June 2011, amended the definition of other comprehensive income in paragraph 7 and paragraph 96. An entity shall apply these amendments when it applies IAS 19, as amended in June 2011. The Annual Improvements 2009 and 2011 cycle, issued in May 2012, amended paragraphs 1038 and 41, deleted paragraphs 3940, and added paragraphs 38A, 38D, and 40A, 40D. An entity shall apply that amendment retrospectively in accordance with IAS 8 accounting policies, changes in accounting estimates, and errors for annual periods beginning on or after the 1st of January 2013. Earlier application is permitted. If an entity applies that amendment for an earlier period, it shall disclose that fact. IFRS 15, Revenue from Contracts with Customers, issued in May 2014, amended paragraph 34. An entity shall apply that amendment when it applies IFRS 15. IFRS 9, as issued in July 2014, amended paragraphs 7, 68, 71, 82, 93, 95, 96, 106, and 123 and deleted paragraphs 139E, 139G, and 139M. An entity shall apply those amendments when it applies IFRS 9. The Disclosure Initiative, Amendments to IAS 1, issued in December 2014, amended paragraphs 1031, 54, 55, 82A, 85, 113, 114, 117, 119, and 122, added paragraphs 30A, 55A, and 85A, 85B, and deleted paragraphs 115 and 120. An entity shall apply those amendments for annual periods beginning on or after the 1st of January 2016. Earlier application is permitted. Entities are not required to disclose the information required by paragraphs 28 and 30 of IAS 8 in relation to these amendments. IFRS 16 leases, issued in January 2016, amended paragraph 123. An entity shall apply that amendment when it applies IFRS 16. IFRS 17, issued in May 2017, amended paragraphs 7, 54, and 82. Amendments to IFRS 17, issued in June 2020, further amended paragraph 54. An entity shall apply those amendments when it applies IFRS 17. The amendments to references to the conceptual framework in IFRS standards, issued in 2018, amended paragraphs 7, 15, 19, 20, 23, 24, 28, and 89. An entity shall apply those amendments for annual periods beginning on or after the 1st of January 2020. Earlier application is permitted if at the same time an entity also applies all other amendments made by amendments to references to the conceptual framework in IFRS standards. An entity shall apply the amendments to IAS 1 retrospectively in accordance with IAS 8 accounting policies, changes in accounting estimates, and errors. However, if an entity determines that retrospective application would be impracticable or would involve undue cost or effort, it shall apply the amendments to IAS 1 by reference to paragraphs 23 and 28, 50, 53, and 54F of IAS 8. The definition of material, issued in October 2018, amended paragraph 7 of IAS 1 and paragraph 5 of IAS 8, and deleted paragraph 6 of IAS 8. An entity shall apply these amendments prospectively for annual periods beginning on or after the 1st of January 2020. Earlier application is permitted, and if an entity applies these amendments for an earlier period, it shall disclose that fact. The classification of liabilities as current or non-current, issued in January 2020, amended paragraphs 69, 73, 74, and 76, and added paragraphs 72A, 75A, 76A, and 76B. An entity shall apply these amendments for annual reporting periods beginning on or after the 1st of January 2024, retrospectively in accordance with IAS 8. Earlier application is permitted. If an entity applies these amendments for an earlier period after the issue of non-current liabilities with covenants, it shall also apply non-current liabilities with covenants for that period. If an entity applies the classification of liabilities as current or non-current amendments for an earlier period, it shall disclose that fact. The Disclosure of Accounting Policies, issued in February 2021, amended paragraphs 7, 10, 114, 117, and 122 of IAS 1, added paragraphs 117A, 117E, and deleted paragraphs 118, 119, and 121. It also amended IFRS Practice Statement 2, Making Materiality Judgments. An entity shall apply the amendments to IAS 1 for annual reporting periods, beginning on or after the 1st of January 2023. Earlier application is permitted, and if an entity applies the amendments for an earlier period, it shall disclose that fact. The Non-Current Liabilities with Covenants, issued in October 2022, amended paragraph 60, 71, 72A, 74, and 139U, and added paragraphs 72B and 76ZA. An entity shall apply the amendment to paragraph 139U immediately upon the issue of non-current liabilities with covenants. For all other amendments, an entity shall apply them for annual reporting periods beginning on or after the 1st of January 2024 retrospectively in accordance with IAS 8. Earlier application is permitted. If an entity applies these amendments for an earlier period, it shall also apply the classification of liabilities as current or non-current for that period. If an entity applies non-current liabilities with covenants for an earlier period, it shall disclose that fact. The withdrawal of IAS 1, revised 2003, signifies that the current IAS 1 supersedes the previous version, IAS 1 Presentation of Financial Statements, which was revised in 2003 and amended in 2005. This means that the revised and updated version of IAS 1 now applies, and the earlier version is no longer in effect. Appendix: Amendments to Other Pronouncements. This section outlines the amendments to other IFRS standards and interpretations that relate to or are impacted by the changes made in IAS 1. The amendments in this appendix shall be applied for annual periods beginning on or after the 1st of January 2009. If an entity applies this standard for an earlier period, these amendments shall be applied for that earlier period. In the amended paragraphs, new text is underlined and deleted text is struck through. The amendments contained in this appendix when this standard was revised in 2007 have been incorporated into the relevant pronouncements published in this volume. Approval by the Board of IAS 1 issued in September 2007. International Accounting Standard 1 Presentation of Financial Statements, as revised in 2007, was approved for issue by 10 of the 14 members of the International Accounting Standards Board. Professor Barth and Messrs. Cope, Garnett, and Leisenring dissented. Their dissenting opinions are set out after the basis for conclusions. The members of the International Accounting Standards Board, IASB, who were involved in the approval process of IAS 1 are Sir David Tweedy, Thomas E. Jones, Mary E. Barthel, Hans-Georg Bruns, Anthony T. Cope, Philippe Danjou, Jan Engstrom, Robert P. Garnett, Gilbert Gellard, James J. Leisenring, Warren J. McGregor, Patricia L. O'Malley, John T. Smith, and Tatsumi Yamada. The Puttable Financial Instruments and Obligations Arising on Liquidation, Amendments to IAS 32 and IAS 1, issued in February 2008, was approved by 11 of the 13 members of the International Accounting Standards Board, IASB. However, 2 members, Professor Mary E. Barth and Mr. Robert P. Garnett, dissented from the approval. Their dissenting opinions are provided in the Basis for Conclusions section of IAS 32, where they outline their differing views on the amendments concerning puttable financial instruments and obligations arising on liquidation. The Puttable Financial Instruments and Obligations Arising on Liquidation, Amendments to IAS 32 and IAS 1, issued in February 2008, was approved by the International Accounting Standards Board, IASB. The board's approval was given by Sir David Tweedy, Thomas E. Jones, Stephen Cooper, Philippe Danjou, Jan Engstrom, Gilbert Gellard, James J. Leisenring, Warren J. McGregor, John T. Smith, Tatsumi Yamada, and Weiguo Zheng. The presentation of items of other comprehensive income issued in June 2011 was approved for issue by 14 of the 15 members of the International Accounting Standards Board. Mr. Pachter dissented from the issuance of the amendments. His dissenting opinion is outlined after the Basis for Conclusions section. The presentation of items of other comprehensive income issued in June 2011 was approved for issue by the following members: Sir David Tweedy, Stephen Cooper, Philippe Danjou, Jan Engstrom, Patrick Finnegan, Amaro Luis de Oliveira Gomez, Prabhakar Kalavacherla, Elke Koenig, Patricia McConnell, Warren J. McGregor, Paul Pachter, Daryl Scott, John T. Smith, Tatsumi Yamada, and Weiguo Zhang. The Disclosure Initiative, issued in December 2014, was approved for publication by all 14 members of the International Accounting Standards Board, IASB. The presentation of items of other comprehensive income issued in June 2011 was approved for issue by the following members: Sir David Tweedy, Stephen Cooper, Philippe Danjou, Jan Engstrom, Patrick Finnegan, Amaro Luis de Oliveira Gomez, Prabhakar Kalavacherla, Elke Koenig, Patricia McConnell, Warren J. McGregor, Paul Pachter, Daryl Scott, John T. Smith, Tatsumi Yamada, and Weiguo Zhang. The definition of material issued in October 2018 was approved for issue by all 14 members of the International Accounting Standards Board. The definition of material was approved for issue by the following members of the International Accounting Standards Board: Hans Hugervorst, Suzanne Lloyd, Nick Anderson, Martin Edelman, Françoise Flores, Amara Louise de Oliveira Gomes, Gary Kabarek, Jianqiao Liu, Takatsugu Ochi, Daryl Scott, Thomas Scott, Chungwoo Su, Antarika, and Mary Tokar. The classification of liabilities as current or non-current, issued in January 2020, which amended IAS 1, was approved for issue by all 14 members of the International Accounting Standards Board. The classification of liabilities as current or non-current was approved by Hans Hugervorst, Suzanne Lloyd, Nick Anderson, Tadeusz Senden, Martin Edelman, Françoise Flores, Gary Kabarek, Jianqiao Liu, Takatsugu Ochi, Daryl Scott, Thomas Scott, Chungwoo Su, Rika Suzuki, Antarika, and Mary Tokar. The classification of liabilities as current or non-current, deferral of effective date, issued in July 2020, which amended IAS 1, was approved for issue by all 14 members of the International Accounting Standards Board. The members who approved are Hans Hugervorst, Suzanne Lloyd, Nick Anderson, Tadeusz Senden, Martin Edelman, Françoise Flores, Gary Kabarek, Jianqiao Liu, Takatsugu Ochi, Daryl Scott, Thomas Scott, Chungwoo Su, Rika Suzuki, Antarika, and Mary Tokar. The disclosure of accounting policies, which amends IAS 1 and IFRS Practice Statement 2, was approved for issue by the following members of the International Accounting Standards Board: Hans Hugervorst, Suzanne Lloyd, Nick Anderson, Tadeusz Senden, Martin Edelman, Françoise Flores, dissenting. Zach Gast abstained. Jianqiao Liu, Takatsugu Ochi, Thomas Scott, Chungwoo Su, Rika Suzuki, Antarika, and Mary Tokar. The non-current liabilities with covenants, which amended IAS 1, was approved for issue by the following members of the International Accounting Standards Board: Andreas Barkow, Nick Anderson, Tadeusz Senden, Zach Gast, Jianqiao Liu, Bruce McKenzie, Linda Mezenhutter, Bertrand Perrin, Rika Suzuki, Antarika, and Mary Tokar. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qlaver.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.